The Shiller P/E ratio is 40.23 right now, January 2026. And you know what? There's only one moment in history when it was higher, 1,999, right before the dot-com crash erased about 80% of the NASDAQ. But here's what should truly scare you. What's forming in 2026 isn't just like 2008. It's potentially worse. In 2008, we basically had one dominant crisis, housing. In 2026, we're looking at 4 crises colliding at the same time, and I'm going to break down what they are, when they hit, and what that collision does to your money. Most economists are saying there won't be a recession in 2026. Deloitte projects 1.4% growth. Morgan Stanley expects a steady, moderate expansion. JP. Morgan puts the odds of recession at 35%. That sounds manageable, right? But these are the same kinds of institutions that in 2007 insisted subprime was contained. The same experts who in 2000 argued the new economy had made recessions a thing of the past. Time after time, these forecasts miss major turning points because their models don't properly account for what happens when multiple systems fail simultaneously. So let's walk through the 4 crises converging in 2026. Once you see how they connect, you'll realize this isn't hype, it's math. Crisis 1 is the commercial real estate breakdown. $936 billion. That's how much commercial real estate debt matures in 2026 alone. Another $525 billion matured in 2025. Together, that's almost $1.5 trillion in loans that must be refinanced at interest rates roughly double what borrowers originally paid. That single change is enough to snap the system. Here's why. A building financed in 2021 at 3% now has to refinance at 6% or higher. That essentially doubles the debt service. But at the same time, the building's value has fallen because office vacancy rates have surged to around 20% nationally. In some markets, like San Francisco, they're approaching 30%. Austin has hit record highs too. That puts borrowers in a no-win position. They owe more than the building is worth. Their payments jump dramatically and they can't sell because buyers aren't there. So what happens next? They give the keys back to the bank and it's already happening. CMBS. Delinquency rates reached 6.59% in the third quarter of 2025. For office properties specifically, the distress rate hit 10.9% in October, up from 6.7% just 2 years earlier. Around 278 banks have been flagged as vulnerable due to concentrated commercial real estate exposure, and more than 900 banks still carry CRE exposure, above 300% of their capital. In 2008, the toxic asset was residential mortgages. Banks had stuffed their balance sheets with subprime home loans that went bad. Today, the weak point is commercial mortgages, office buildings, retail centers, and multifamily properties turning sour. Same transmission mechanism, just a different asset class. During the Great Financial Crisis, the banking system absorbed roughly $400 billion in losses. In this cycle, commercial real estate losses could come in above that figure. Crisis 2 is the stock market bubble. With the Shiller P/E ratio around 40, we're looking at the second highest reading in roughly 140 years of data. The only time it was higher was December 1999 when it hit 44.19, and we all know what followed the S&P. 500 dropped about 50% and the NASDAQ plunged roughly 78%. Then there's the Buffett indicator, which compares total stock market capitalization to GDP. It's sitting near 225%, while the long-term average is around 80% to 100%. Anything above 160% is typically viewed as materially overvalued. Buffett himself warned that ratios approaching 200% suggest investors are playing with fire. If that framework holds 225% isn't a warning light, it's a flare. The next problem is concentration risk. 7 stocks, the so-called Magnificent Seven, now make up more than 30% of the S&P 500's total market cap. Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla. If those 7 names correct, the index doesn't just wobble, the whole market gets dragged with it. This isn't real diversification. It's concentration dressed up as an index. And the story driving these valuations, the AI boom, rhymes with the late 990 seconds internet boom, a revolutionary technology, real productivity improvements, massive capital spending, and stock prices that go vertical. Then a crash that vaporizes trillions in paper wealth. The debate isn't whether AI is real. The internet was real too. The real question is whether today's prices reflect reality or fantasy. At 40 times cyclically adjusted earnings, fantasy is ahead on points. Historically, when CAPE ratios have stayed above 30 for extended stretches, markets have eventually suffered corrections of 20% or more. At 40, we're not pricing in growth. We're pricing in perfection, and perfection doesn't exist. Crisis 3 is the debt doom loop, $38 trillion. That's the national debt as of this month. It was $36 trillion at the start of 2025, meaning we're adding roughly $2 trillion per year. But the number that matters most is $1 trillion what the federal government paid in interest during fiscal year 2025. Interest is now the second largest line item in the federal budget behind only Social Security, larger than Medicare, larger than defense. The Congressional Budget Office projects interest payments could reach $1.8 trillion annually by 2035. But that projection assumes interest rates come down. What if they don't? What if they rise instead? Every 1% increase in average rates adds roughly $380 billion in annual interest costs. Here's how the doom loop works. High debt forces heavy borrowing. Heavy borrowing pushes rates upward. Higher rates inflate interest expense. Higher interest expense widens deficits. Wider deficits demand even more borrowing, and the cycle reinforces itself until something breaks. In 2026, the federal government could spend roughly $1 trillion just to pay interest. $1 trillion that doesn't build roads, doesn't fund schools, doesn't strengthen defense, and doesn't create anything new. It simply services old borrowing, and that's what makes 2026 especially dangerous. The debt ceiling was reinstated in January 2025 at $36.1 trillion, and we've already blown straight through it. That means another debt ceiling showdown is on the way, and another credit rating downgrade isn't off the table. Moody's already cut the U.S. from its highest rating in May 2025. The runway is shrinking fast. In 2008, the spark was private sector debt mortgages, credit cards, corporate borrowing. The next crisis is more likely to be sparked by sovereign debt, government borrowing, and that's a much tougher problem to solve. Because the institution that usually steps in to stabilize the system is the one that's under stress. Crisis 4 is the consumer hitting a breaking point. Auto loan debt has reached $1.66 trillion. The average payment is $748 per month. Subprime auto delinquencies are at 6.65%, the highest since tracking began in 1994. In 2021, 73 million vehicles were repossessed the most since 2009, and 28% of trade-ins are underwater, meaning borrowers owe more than their cars are worth. Average negative equity is $6,900. Nearly 1 in 4 underwater borrowers owes more than $10,000 on vehicles worth less than the loan balance. At the same time, credit card debt is above $1.1 trillion. Average APR is over 20%. Delinquencies are rising. Student loan payments resumed after years of forbearance. The typical American household isn't stretched, it's tapped out. Here's the signal that scares economists the most. Car loans are often the last bill Americans miss before the mortgage, before credit cards, because you need a car to get to work. When auto delinquencies spike, it suggests households have already used every other lever they've cut, spending maxed out credit cards and burned through savings. They're out of options. Subprime borrowers aren't some tiny side story, they're the canary in the coal mine. When they crack, the stress doesn't stay contained. It climbs the income ladder, and right now subprime is breaking at rates not seen since 2008. Now, connect the dots, because any one of these issues might be containable on its own. Together, they form feedback loops that intensify each other. Commercial real estate losses hit banks, and banks tighten lending across the board. Tight credit slows growth. Slower growth pushes unemployment higher. Higher unemployment triggers more consumer defaults. More defaults create more bank losses. The spiral feeds itself. At the same time, if stocks fall 20% to 30%, the wealth effect flips. People who felt comfortable because their 401k was rising suddenly feel exposed. They pull back spending. Revenues fall. Earnings drop. Companies cut jobs. Defaults rise again. The market decline becomes self-reinforcing. And running through all of it is the government's shrinking ability to respond. It can't stimulate the way it did in 2008 or 2020 because it's already running roughly $2 trillion deficits, even at full employment, and interest costs are already around $1 trillion. There isn't much fiscal space left, and the Federal Reserve can't just slam rates to zero again if inflation still isn't fully dead. Inflation is still above the Fed's 2% target. That's the trap the Fed is stuck between fighting inflation and preventing a recession, and it can't fully win both battles at the same time. In 2008, we had one major crisis and what felt like endless policy ammunition. In 2026, we're staring at 4 crises with very little ammunition left. That's why 2026 has the potential to be worse than 2008. Now let's take apart the objections one by one. First objection: the economy is resilient. GDP growth is still positive. Unemployment is still low. But GDP was positive in 2007 too. Unemployment was low in 2007 too. Stocks were sitting at all-time highs in October 2007. Everything looked fine until it didn't. Recessions aren't obvious in real time. They're usually clear only in hindsight. By the time the data officially confirms a recession, you're often already about 6 months into it. That's why the indicators I've laid out matter. They're forward-looking. They tell you what's likely coming, not what has already arrived. Second objection: banks are stronger now. Yes, they have more capital and tighter regulations, but they have more capital for the risks regulators plan for, not for concentrated commercial real estate exposure on this scale. We're talking about 900 banks with CRA exposure above 300% of capital and 278 banks already flagged as vulnerable. Regulation is usually built for the last crisis. It almost always is, and the next crisis shows up exactly where the framework has a gap. Third objection, the Fed will save us. They'll cut rates, they'll print money, but the Fed's balance sheet already peaked near $9 trillion, and they're trying to shrink it. Inflation is still above target. Cutting aggressively risks bringing inflation roaring back. Printing money when debt to GDP is already around 120% risks a currency crisis. The Fed's playbook was built for deflationary recessions. So what happens if the crisis is inflationary? What happens when rates can't go to zero because inflation won't allow it? We're about to find out. Fourth objection, this time is different. AI will drive massive productivity gains. Technology will rescue the economy. That's exactly what people said about the internet in 2000, real technology, real productivity gains, and stocks still crashed 78%. The technology was real, the valuations weren't. AI is real. Nvidia's revenue growth is real. But when CAPE hits 40 and the Buffett indicator hits 225, you're not paying for technology, you're paying for a story, and stories don't produce earnings. Sooner or later, reality shows up. So what do? 6 steps to get through 2026. First, stress test your portfolio for a 30% to 40% drawdown. If you can't live with that kind of hit, reduce exposure now, not after the damage is done. Second, build cash reserves 6 to 12 months of expenses at minimum. In a credit crunch, liquidity is king. The people who had cash in 2008 and 2009 were the ones able to buy assets at generational lows. Third, cut back on rate-sensitive exposure, long-duration bonds, highly leveraged companies, commercial real estate, anything that cracks when rates stay higher for longer. Fourth, diversify geographically. International markets are trading at meaningful discounts compared to the U.S. The Shiller P/E for developed markets abroad is roughly half the U.S. level. And when the U.S. finally corrects, money doesn't just disappear, it often looks for a new home. Capital can rotate elsewhere. Fifth, own hard assets. Gold made record highs in 2025 for a reason. Central banks have been buying at the fastest pace in decades. They're reducing reliance on dollar-based assets, and if the most powerful institutions on earth are diversifying away from the dollar, it's at least worth asking whether you should consider doing some of the same. Sixth, watch the signals. Track CMBS delinquency rates. Track auto loan delinquencies. Watch the yield curve. Watch bank earnings. When these indicators deteriorate faster than expected, the timeline compresses and what looked manageable can turn urgent overnight. The mainstream outlook is still a soft landing, a mild slowdown, no recession, moderate growth. That's the base case. But base cases assume nothing breaks, and right now 4 major systems are all flashing warning signs at the same time. Commercial real estate, $936 billion maturing in 2026, falling values banks exposed. Stock market, Shiller P/E at 40, Buffett indicator at 225, and extreme concentration in 7 mega cap names. Government debt, $38 trillion total, about $1 trillion a year in interest, with debt ceiling drama looming again. Consumers stress everywhere, record auto delinquencies, record negative equity, record repossessions. Any one of those could be the trigger. All of them together create conditions that could be worse than 2008, not because one single crisis is bigger, but because the system has fewer shock absorbers left. In 2008, we had a crisis and a response. Massive fiscal stimulus, zero interest rates, quantitative easing, bank bailouts, every tool in the toolkit was used. In 2026, we could have a crisis with constrained responses, high debt limits, fiscal stimulus. Inflation limits aggressive rate cuts. Political dysfunction limits coordinated action. The tools are blunter and the problems are sharper. Here's the uncomfortable truth. Nobody knows the exact breaking point. It could be the first quarter of 2026. It could be late 2026. It could be 2027. The timing is uncertain, but the direction isn't. You can't run a 40 Shiller P/E, a 225 Buffett indicator, $1 trillion in annual interest payments, 20% office vacancy, and record consumer delinquencies forever. Something eventually gives. The only real question is whether you'll be positioned to withstand what's coming or whether you'll be another casualty of the next major unwind. The data is public. The warning lights are flashing. The same experts who missed 2008 are telling you everything is fine. You have to decide who to trust. If you want to stay updated as these pressures build, subscribe. In the next video, I'll break down exactly which assets performed best during the 2008 crash, what the playbook could look like for 2026, and the specific moves to consider before a major correction hits, because by the time headlines confirm a crisis, the window to prepare is already gone. The bill for 20 years of easy money is coming due. 2026 is the year the check shows up. Will you be ready to pay it, or will it be paid with your wealth? And let me add one more layer, the historical pattern. Every major financial crisis tends to follow the same sequence: excess euphoria, exhaustion, collapse, reset. We've seen it before in 1873, 1929, 2000, and 2008. The names change. The assets change. The pattern doesn't. In the 1,870 seconds, the excess was railroad speculation. In the 1,920 seconds, it was stocks bought on margin. In 2000, it was internet companies with no earnings. In 2008, it was mortgage-backed securities stamped with fake safety, and in 2026, it's AI stocks priced at 40 times earnings, commercial real estate refinancing at double the rates, government debt pushing toward $40 trillion, and consumers stretched to the limit across every category, and the euphoria phase always sounds identical. This time is different. We've evolved past the old rules. Technology changes everything. Smarter people are in charge. A new paradigm has arrived, then comes exhaustion. The first hairline cracks show up. Then comes the collapse. What was contained suddenly isn't. What was isolated turns out to be connected. The fire spreads, and after that, the reset prices fall back to levels that make sense again. Assets transfer from weak hands to strong hands, and the cycle begins again. Right now, we're sitting in late euphoria, early exhaustion. The cracks are already visible. CMBS delinquencies, auto loan defaults, and bank vulnerabilities. But the expert chorus is still singing, the same tune contained isolated different this time. The pattern disagrees. The pattern is never different. Only the labels change. In 2008, Lehman Brothers collapsed on September 15th. But the warning signs started in 2006 when mortgage delinquencies began rising. 2 full years of warning, 2 years most people ignored because the smart money said it was contained. The warning signs for 2026 started in 2023. Commercial real estate, strain, consumer delinquencies, and pressure on bank earnings. We're already about 2 years into the warning phase. The real question isn't whether a Lehman moment arrives, it's when. Maybe it's September 15th, 2026. Maybe it's late 2026. Maybe it's 2027. I'm not calling an exact date. Nobody can. What I'm saying is the conditions are in place. The fuel is stacked. The kindling is dry. All that's missing is the match. And in markets, matches always show up eventually. The responsible response isn't panic, it's preparation. You don't have to nail the exact moment everything turns. You have to be positioned so that if and when it happens, you aren't wiped out, you're ready to take advantage. Cash gives you options. Low debt gives you flexibility. Diversification gives you protection. Hard assets give you insurance. Those aren't predictions. They're precautions. Maybe 2026 is the year everything breaks. Or maybe it's another year of extend and pretend where the system holds together a little longer. But one thing is clear. The risks are elevated and the warning lights are blinking. The people who prepared before 2008 were the ones who did well after it. So the choice is yours. Trust the experts selling a soft landing or trust the data flashing red, a Schiller P, E near 40 CMBS delinquencies, around 7% auto defaults at 30-year highs, and roughly $1 trillion a year just in interest. Payments. The experts have a track record. The data has a track record. You decide which one you believe. Subscribe for the next video, where I break down exactly how different asset classes behaved in 2008, what protected wealth, what destroyed it, and how to translate those lessons into a 2026 playbook before the correction shows up. Because history doesn't repeat, but it rhymes, and right now the rhyme sounds a lot like 2007.